Start your presentation.
Yes, sir. Hello everyone, my name is Yash Bhavar and my topic is financial modeling, a big strategic tool of business in decision making. The disclaimer is by allowing the presentation, I grant permission for it to be uploaded, shared across various social media platforms and the official website of iCapital Academy and Corporate Advisory LLP. The next slide. What is financial modeling? Financial modeling, it means the process of creating a spreadsheet based tool upon that represent the financial performance of the business, and it combines historical data, uh, assumption and financial formulas to forecast their outcomes. The key components of the financial model is input data processing, logic, outputs, and tools. Uh, in that key components, there are core elements like revenue projection, cost structure, working capital and financing, and valuation like NPV, IRR, and DCF. And why is financial modeling is important? It enables decision by the supporting strategic activities like MA, IPO, budgeting, and capital allocation. It's simulating various business scenarios and evaluating risk and financial aid. It is used in equity research and credit analysis or corporate energy and startups. Uh, Seventh slide is benefits of financial modeling. Um, it represents data-driven decision making in a budget and forecast creation. It enhances investor confidence and facilitating fundraising and scenario analysis and business planning. And then types of financial models. It means most common types are included in three statement model, discounted cash flow, merger model, and leverage buyout model, budgeting and forecasting model, and option pricing model. Then three statement models. It integrates income statement, balance sheet, and cash flow statement, and used for the forecasting performance, like forming the foundation for other models like DCF and MA. And discounted cash flow model. This model purpose estimates a company in strict value based on future free cash flow discounted to present using WACC, and widely used by analysts, MA, and investors. And slide 11 is real world application in financial modeling. In just in startups used to raise capital, forecast growth, and estimate burn rate and help to predict future case needs. Second is corporates. Corporates is used for strategic planning and forecast earning, and helps in deciding investment, managing working capital, and structuring finances. Third one is the banks. In banks, the credit risk assessment before lending and simulates borrower repayment capacity. And fourth one is the investors. In investors valuation and in structuring scenario, planning for the exit strategies. Then A summary and takeaways in financial modeling is a critical skill combining logic, finance, and Excel, and it enables stakeholders to make informed decisions. Like use AI and Excel evolve, financial models are becoming more powerful and accessible. Then Excel for financial modeling introduction. Excel is a primary tool is used for building structure models, analyzing performance and forecasting outcomes, and it supports budgeting, valuation, investment analysis, and uh, strategy formulation. And leverages are in formula charts, uh, data analysis, and automation. Then the agenda of Excel for financial modeling is formula and function, pivot tables, uh, what if analysis, dashboards, and financial model structure. Then the slide 15, formulas and function, why Excel for financial modeling. Then Excel offers a flexible platform with built-in financial and statistical functions. Its structure supports assumption-based inputs, layered calculation, and dynamic outputs. And the key formula categories is in math, sum, average, and round. In logic, if and or, and in lookup, VLOOKUP, and HLOOKUP, and index match. In finance, NPV, IRR, PMT. In text dates, concat, left, and today. In math functions, sum adds values, average, round, and used to calculate average and round value in financial models. Then in logical functions, if in bracket A2 is greater than 1000, profitable loss, and B1 greater than 0 is C1, uh, lower than 500, or helpful in scenarios, flagging, and conditions. And in logical functions, create conditionally outputs, flag risk or exceptions, enable scenario logic. And VLOOKUP and HLOOKUP, in this VLOOKUP and HLOOKUP put related data from tables, match input data with examples. Then only research right, index the match is preferred for flexibility. Then index and match, in this point, the more powerful lookup combination, uh, index and match uh, index match is a more powerful lookup combination, faster, more accurate, and can look up both left to right and common in professional models. Then financial formulas, NPV and IRR. NPV, it means net present value. It calculates the present value of future cash flows discounted at a required rate. And the formula is NPV in bracket rate value 1 and value 2 dash. There are more values who are put in formula and then bracket close. Example, NPV 10% and A2 dot A6. In IRR, it means internal rate of return. In that, returns the discount rate in which at which NPV is zero. Formula is IRR in bracket values, bracket complete, and it is used for the project evaluation and investment appraisal. Slide 22. Uh, Text and date functions, and this is used for the formatting, cleaning, and automating model input. In is equal to in concat, they combines text from two cells and left uh, they extracts the first five characters today or now. It returns current date and time, and this is helpful for label, dynamic reporting, and time stamping model inputs. Then absolute versus relative references. Understanding Excel references, relatives A1, it means changes when copied. Absolute, it means stay constant during copy paste. And its example in row based calculation ensure accurate formula behavior across the sheet, and it is used for stability in models and consistency in calculation. Error handling to prevent models from crashing or displaying div or o in other errors. Then first is IFERRO RA1B1 check input displays message instead of error. Then second one is the IS number A2 equal to ISS RRORB3. It checks if A2 is a number. Then the third one is uh, B3 is it checks returns true if there is an error. It is they are important for to keep output cleaning in Excel and improves user experience and supports error tracking. Then pivot table and data summarization. What is pivot table? Pivot table, it means in Excel there the powerful tool in Excel is pivot table. They summarizing largest data sets and performing calculation like sum, average, and count. The feature of pivot tables is drag and drop interface and real-time aggregation. For examples, so use pivot table uses sales by region and cost breakdown by categories. And next slide is creating a pivot table. Select your data table, go to insert and then pivot table, choose placement and drag fields into rows, columns, values, filters, and quickly analyze structured data. Then real financial use cases. Um, it in that budget versus actual comparison, it compares planned versus real expenses, monthly revenue analysis. In that track trends over time, cost allocation, it means allocate cost by department or region, transaction consolidation, summarize thousands of rows into digestible summaries. Then your table tips, best practices, clean your data set, no more cells, and consistent headers. Second one is use Excel tables for dynamic ranges, refresh data and when underlying data changes, use filters to isolated key metrics. Then pivot charts, it means add visual level to pivot tables, types, column, line, pie, etc. and interactive with slicers and filters, and it is useful for dashboard presentation and monthly reports. What if analysis? Analysis overview helps evaluate different scenarios by changing inputs and includes goals like find input to achieve a desired output, and second one is scenario manager, compare base towards cases outcomes, and in third data tables analyze impact of changing one or two variables used for sensitivity analysis, pricing strategy, and investment forecasting. Third, then goal seek. The purpose of goal seek is used to find the right input when the desired output is known. For example, uh, you want net profit to be of rupees 1 lakh, then goal 6 helps to determine the necessary sales amount to achieve that profit. And then steps is go to data, and then what if analysis and goal 6 set sell the formula sell, for example net profit to value desired result, example rupees 1 lakh, and by changing sell input variable, example is sales. Then the scenario manager. The purpose of manager is saves multiple input scenarios, best base and worst case, and it compares their outcomes side by side. Then steps of scenario manager is go to data, what if analysis, and scenario manager at different sets of inputs and view impact on their on outputs like profit and ROI. Use cases is strategic planning and comparing pricing or growth rate assumption. In data tables, there are two variables. One first one is one variable and second is two variables. One variable table, it means vary one output, example interest rates, and see its effect on NPV. And second one is the two variable data table, vary two inputs and see outputs. And steps of the data table is create a grid and input values, and link output cell, example net profit in top left corner, and use data if analysis and data table. And then next slide is finance use cases of what if analysis. First one, IRR sensitivity. IRR in this point, see how changes in cost affect internal rate of return. Then second one is net profit projection is based on sales or pricing changes. Third one is the exp, expense planning. Uh, Under inflation, the under inflation or cost or increases. Then loan repayment, analyze EMI or under different interest rates. Then best practices in modeling, separate into cells, use one sheet or section or assumption. Label clearly indicate purpose of each input. Color codes is blue, black, and green are bold. Avoid hard coding, use references, and avoid formula instant. Then section is chart and dashboards. Why use charts? The charts turn number into insights and helps explain trends and comparison for forecast. Common charts is line chart, column bar chart, pie chart, and valuable charts. In common chart types, in line chart, revenue trends across quarters, column chart, expense breakdown by department, pie chart, market share to cost propositions, and waterfall chart, profit bridge from revenue to net income. Charting tips is keep it simple or focus, and then use consistent colors and formatting, then add data tables and axis titles, and then avoid clutters and don't overuse 3D or unnecessary visuals. Dynamic charts and name ranges, use formula like offset and index or Excel tables to create dynamic ranges, and then chart automatically update as the new data in is added in Excel. And then they helps build flexible financial models. For example, monthly sales chart updates as new month data is added. Then introduction of dashboards. And the dashboards provide a high level view of key performance metrics and interactive charts and visuals. And then they provide real time scenario monitoring. The components of dashboards is pivot tables, charts, slicers, and KPI. KPI it means key performance indicators. Then creating a simple dashboards. Step one, preparing clean data. Use structured tables and clear headings. Then second steps is build pivot tables for metrics like sales, revenue, and profit cost categories. The steps three is insert charts linked to pivots. For example, bar, line, and pie. Fourth step is add slicer. Add slicer to filter by a product. Uh, Region or period dynamically. Fifth step is design layout. In this design layout, use colors, boxes, and labels for clarity. The use case is monthly business review with filterable views for managers or investors. Then final recap and best practices. The best practices in financial modeling. In that, keep first one is keep models modular and layered. Second one, use standard formats and color convention. Third one is avoid clear circular reference unless needed. Fourth is always test your model using dummy data or reverse logic. And fifth one, maintain the version history. For example, V1, V2, etc. for major model changes. And then build a basic financial model. The introduction of basic financial modeling is financial modeling structure. First one is input sheet, all assumption like growth, rate, cost, percent, price per unit. Second was the calculation sheet, revenue, cost, depreciation, tax, interest, etc. And the third one is the output sheet, income statement, balance sheet, and cash flow is KPI. Then importance of financial model. The The financial model supports strategic decision making and helps in fundraising and investor communication. It is used in budgeting, forecasting, and valuation, and the delivery of document updated quarterly and monthly. And types of the financial model is three statement, DCF model, M&A model, LBO model, and forecasting and budgeting model. Then in three statement model, it integrates income statement, balance sheet, and cash flow. DCF model. In this model, project FCF and calculate intrinsic value. M&A model It means analyze strategies for post-merger financials. An LBO model is leveraged buyout modeling and forecasting budgeting model, annual or multi-year projection. Then key components of a financial model is revenue projection, cost structure, capital expenditure, working capital changes, financial assumptions, valuation metrics. These are the models of over 3 to 5 years and from the foundation of business planning. Then model structure in Excel. In input sheet, in first one is the input sheet. In that, business drivers growth, growth percentage, pricing and unit calculation sheets. In that, revenue, cost of goods sold, depreciation, interest, taxes, and expenses. In output sheets, the financial statements, valuation summary, and key ratios. And then, what is revenue modeling? Revenue models vary by industries and it forecasts how the business makes money. Base formula is revenue equal to price into quantity. It requires price assumption value estimates. Then types of revenue streams is product sales, subscription services, licensing, advertising, consulting. Each stream could be modeled separately for accuracy. In that transactional, one-time sales, recurring subscription, use base, pay-per-use and premium, ad base, pre-access and ad revenue. Then next size is revenue forecasting and linking. First one is growth rate calculation. It is growth rate calculation estimate how revenue increases month over month and year over year. Then formula of revenue equal to revenue year n minus 1 into 1 plus growth rate. It is used to project future revenue model scenarios. Example is 10% growth and 5% decline. Second, then next slide is revenue forecast in Excel, monthly and quarterly tables. Split forecast into detailed intervals, making financial and more precise. Second one is revenue stream separation. In that each line of business model separately, and it includes unit pricing, seasonal effects growth, year to date, and year over year summaries. Then making revenue dynamics. In that use Excel formulas like index, choose if and match for logic control, and add use drop to switch between scenarios and slicer to switches for automation. The goal is allow user to simulate how changes affect revenue in real time. Then link to financial statement. Once revenue is forecasted, link it to it, then income statement or cash flow statement and balance sheet, and link total revenue to top line of income statement. And the best practices use cell reference. or not hard coding to connect sheets. Then expense modeling types of expenses is cost of goods sold. In that direct production cost and material in that material and labor. And then second one is operating expenses, OPEX. In that sales, admin, marketing, rent, and utilities. Then next is the depreciation. In depreciation, non-cash expense affect cash flow and taxes. Then what is meant by COGS modeling? COGS modeling in two common methods. First one is the percentage of revenue and per unit basis. The formula of percentage of revenue is COGS equal to revenue into percentage of COGS. Per unit basis is a formula equal to COGS equal to units sold into cost per unit. It is used for manufacturing per unit modeling and service percentage of revenue modeling. Then operation expense breakdown, the fixed costs, rent, salaries, and the second one is the variable cost, and then split into sales and marketing, general and admin, R&D and depreciation, and use percentages or fixed values. Then building expenses tables in Excel, row by row method, each cost category in separate row, and it is useful for fixed values. Formulas like revenue plus percentage of expense or direct entries. Growth factor formula is equal to last year into in bracket 1 plus growth rate bracket complete. Include monthly and quarterly breakdowns. Then EBITDA and EBIT. In EBITDA, it means earning before interest, taxes, depreciation, and EBIT equal to depreciation and amortization. These are the key performance indicators input to DCF and valuation models tracked by investors and analysts. Then linking expenses to the statements. Um, income statement as line item below revenue, cash flow statement, operating outflows. Ensure consistent formula and reference and use subtotal lines to calculate gross profit, EBITDA, and net profit. Then cash flow modeling. The purpose of cash flow modeling is track cash movements. It means um, it is just not just accounting profits, then divided into operating activities. It means cash from core business, example collection from sales. Then investing activities means purchase or sales of the assets. Then financing activities, it means loan, dividends, equitations. It is important for shows liquidity and help us assess solvency and sustainability. Then indirect method overview. Most common method used in financial model is start with net income, adjust for non-cash payment, non-cash item, for example, depreciation. Changes in working capital equal to cash from operation. This is a method to use professional models to standard accounting. Then modeling operating cash flow. The components of modeling operating cash flow is Start with net profit, then add back depreciation and adjust for the accounts receivable, accounts payable, and inventory. Then modeling, investing in cash flow, capital expenditure, purchase of plant, equipment, etc. Then proceed from asset sales and then investment income. Modeling, financing, cash flow in that point, it includes debt inflows, new loans or bonds issued. Then second, inflow, debt repayment, and third, equity inflows and dividend paid. In balance sheet modeling, the overview of balance sheets, it represents financial position at a point in time. The basic formula is assets equal to liability plus equity, and it is useful for assessing net worth, verifying financial stability, and ensuring all funds are sourced and used correctly. Then current asset modeling. First one is cash in cash, ending balance from cash flow statement. Then account receivable based on DCO, days sales or outstanding. Formula is account receivable equal to revenue divided by 365 into DSO, means days sales outstanding. In inventory, based on turnover ratio, the formula is turnover ratio is inventory equal to COGS plus inventory turnover ratio into 365 days. Then liabilities modeling. In liabilities modeling, it includes current liabilities. Uh, in that accounts payable, the formula of accounts payable is COGS divided by 365 days into DPO. It means days payable outstanding. And ET current liability is used for short-term loans and long-term liabilities. In term loans, bonds, lease obligation, these should be matched the financing cash flows from earlier. Then next slide is equity section. In share capital, any share plus any shares issued, the returning earnings. The formula is uh, operate opening retained earnings plus net income minus dividends. Then other reserves in premium revolution reserves, etc. Equity reflects ownership and value built over time. Then balancing the sheet, final step. The final steps equal to total asset equal to total liabilities plus equity. Use a balance sheet formula to be flag errors. Then DCF and finalization. What is DCF? DCF is a discounted cash flow. Is a valuation of a method used to estimate the intrinsic value of the business based on their future free cash flows. These future cash flows are discounted to the presenting using the discount rate, usually WACC, usually used for WACC. It means weighted average cost of capital. The use of DCF is investment decisions and business valuation or M&A or fundraising. And in free cash flow calculation, it means actual cash generated after covering capital expenditure and working capital needs. The formula of FCF is EBIT into in bracket one minus tax return bracket complete plus depreciation minus cap EX minus working capital. Then forecasting FCF equal, then forecasting use for 5 to 10 years, use model outputs to determine year-wise revenue and expense projection, CapEx plan and working capital changes. Build a table with year FDF, discount factor and present value of each year FCF. Then terminal value. After a forecast period, we calculate a terminal value to capture future cash flows in perpetuity. Then formula of Gordon growth model is TB equal to final year FCF into in bracket 1 plus G bracket complete divided by W in bracket WACC minus G. Or exit multiple method is method of formula is, for example, EV divided by EBIT DA into final year EBIT DA. Then present value of cash flows. All forecasted FCF and terminal value are discounted to present values using uh, Excel formula is PV equal to future value plus 1 divided by WAC, sum of all PV's enterprises value. Then value DCF valuation summary. Enterprises value is PV of FCF and terminal value. Equity value EV minus debt plus cash and share value. Share price is equity and number of shares. Then final dashboards. Then the final dashboards. In that, the dashboard summarize all financial model outputs. Then key element of KPIs is revenue, EBITDA, net profit, and FCF. Then in charts, revenue versus expense, cash flow trend, DCF, and waterfall. And sensitivity tables, impact of changes in WSAC or growth rates. The purpose of this final dashboard is give stakeholders a visual at a glance summary of performance and valuation. Advanced Excel in financial modeling. It it means the enables faster error-free financial model updates and allows automation of routine tasks like report generation or formatting. Then third, help build dynamic interactive models used by the top analysts and consultants. Fourth is bridges of gap between spreadsheets calculation and powerful functionality. It is used by analysts, consultants, CFO, and investment professionals for real-time financial decision making. Then next one is the why this module covers the just a second. Then next one is the what this module covers in VBA, Visual Basic for Application. Uh, these upcoming sections will cover advanced formulas, VBA, dashboards, scenario analysis, and real-world use cases. Each of these helps to build scalable and these professional grade models and real-world use cases. Advanced modeling helps in automating weekly sales reports, building CFO dashboards, what if analysis for investment, updating models with one click, and generating financial statements programmatically. Real professionals use these skills to save time, improve model accuracy, and deliver insights quickly. Then next slide is best practices in advanced modeling to ensure scalable and professional models. First one is avoid hard coding numbers. Always use input sets. Then use modular formula. Break calculation into steps, and then apply name ranges and structured tables for clarity. Then keep inputs and outputs separated clearly and add error and check logic using if error conditional formatting and alerts. These practices are essential for auditing, collaboration, and maintenance. The next slide is Excel function recap before going advanced. Keys Excel categories for advanced modeling is logical, illogical, if and of and if error. Then second lookup, VLOOKUP, HLOOKUP, XLOOKUP, index match for connecting data sets. Dynamic areas is Excel 365 for 2019 plus. It means filters, sort, unique, and sequence for dynamic list generation. Reference for reference function in indirect and offset to build flexible ranges and name arrays. VBA. Next one is the VBA, Visual Basics for Application. What is VBA? VBA, it means built-in coding language in Excel used to automatic tasks, recalculation, formatting, exporting, and then building custom financial tools, control workbook behavior. And X is VBA via press Alt plus F11 to open the VBA editor. And they use widely by investment bankers, consultant, and analyst. Then writing your first macro in VBA. Then, for example, is clear input sales macro. Then, first one is VBA, then copied it, sub get input sales, and the sub declares macro book range is specified, refers to sales, and clear content is deleted values but keeps formatting. It is used to reset a model before new assumption, build automation into dashboards. Common VBA application. The common VBA application, first one is clear input before running a new scenario, then updating charts for reports with one click, exporting dashboards to PDF, and then automatic data reports run scenario analysis. VBA enhance productivity and eliminates to repetitive tasks. Then we have VBA practices. Always use option explicit to forest valuable declaration. Use MSG box or debug to print or debugging, and avoid using select and activated. Instead work of objective reference and modulus code. It in that break large scripts into smaller reusable process. These habits lead to clean professional and reusable code. Then what is macros? A macros, it means a macro is a recorded or written set of steps that can be replayed. It is created by micro recorder and VBA code. And purpose of macros is automatic manual Excel tasks. Then recording and running macros, go to developer and record macro, give it then perform access example, change format and change insert rows, then click stop recording and run via developer, then macro or by assigning it to be a button. then assigning macros to the buttons. Then first one insert shapes, then draw button and right click and set macro. And great for financial interact. It is great for the financial interactive financial models like update forecast, generate report and refresh dashboards. It is used to clear inputs, learn scenarios and export reports and enhance usability for non-technical users. Then dynamic dashboards and dynamic dashboards. What is dynamic dashboards? Dynamic dashboards, it means visually displays financial KPIs that update automatically when assumption change, time periods change, and user selects scenarios. The feature of the dynamic dashboards is pivot table, slicer, conditional formatting, and interactive charts like line, column, and waterfall. It is used for management review, investor pitch, decks, and real-time planning. Then next slide is elements of dynamic financial dashboard. A well-designed dashboard includes KPI, interactive charts, pivot tables, slicer drop-down, and conditional format. Element dynamic financial dashboard is display complex data in simple interactive view for the decision makers. Then steps to build one. Uh, Prepare cleaning. It means use Excel tables for dynamic ranges. Create pivot tables for summarize by month, category, or product. Insert charts like line, column, pie, water, or link to pivot table. Then fourth one, add slicer and controls for regions, years, and product types. Use offset index match. This is useful for make charts auto update with data changes. Then design layout. Use borders, themes, titles, and consistency. Then what is scenario analysis? Scenario analysis, it means evaluate how changes in key assumption affect outcomes. It compares basic case, best case, and worst case. For example, growth rate base 5%, best 10%, and worst 5%. It is used for stress testing and risk analysis. Then using scenario manager. Go to data and what if analysis and scenario manager. Add new scenarios with different values from key drivers. Then run comparison summary to see changes in outputs like revenue, EBITDA, and net income. This is useful for present presentation and boardroom and decision making. Then sensitivity analysis using data tables. Sensitivity analysis change one or two variables and see effect on output. For example, discount change discount rate and see how this valuation varies. Change price and column, see effect on profit. The steps of the sensitivity analysis is a setup table with verifying inputs, link outputs, for example, net profit and IRR. Then use data, what if analysis and data table. Then setting up input drivers, create a clean assumption sheet. It includes growth rate, cost of capital, CapEx, and operating margin. B- And use name ranges and data validation list. Integration dashboard plus VBA plus scenarios. Combine techniques for full interactivity. Use drop-downs plus index match to changes inputs dynamically. Then create macros and VBS to switch scenarios and link input cells to charts pivot table and KPI box. It is useful to fully interactive financial model for management and investors. Then AI introduction of AI in financial modeling. It means AI is a transporting financial modeling by increasing speed and accuracy, improving pattern recognition, automatic, repetitive tasks. It is useful for forecasting, valuation, credit scoring, and financial reporting. And the key benefits of AI in financial modeling is speed, accuracy, pattern recognition, and automation. Then traditional versus AI-driven financial model. In traditional model, the first one is manual data entry, and AI driven model is automated data collection. Then second one is the strategic assumption in traditional model and AI driving models in real-time learning and adoption. In a transitional model, time-consuming analysis. In AI-driven model, fast and dynamic forecast. In a traditional model, use defined logic and an AI-driven model, algorithm-driven decision making. AI transports spreadsheets into an intelligent prediction engine. Then core AI techniques use machine learning in regression, decision trees, and XGBoost, etc. Then second one is the natural language processing (NLP). In that, read reports and extract sentiment. Then third one, deep learning. In that, neural networks for price forecasting. Then reinforcement learning. It is applied in algorithm trading, and this is integrated into Python, R, and increasingly into Excel plugins and cloud tools. Then machine learning in finance. FN, ML definition and ML helps base analysts like forecast future revenue, predict stock price movement, identify customer, detect fraud in transaction, and common LM models is linear regression, XG, random forest, and k-means. For continuous variables, an ML requires to historical data in training algorithms. And the types of machine learning in finance is supervised, unsupervised, and reinforcement learning. And use cases in revenue forecasting, fraud detection, and credit scoring. Then Python for financial modeling. Why Python? It is a open source, powerful, and well supported. And key libraries like Pandas, MPV, Skillet Learn, and TensorFlow and PyTorch. For example, is use XLWS and Open PyXL to connect Python Excel and dynamic updates. GPT and generative AI in financial modeling. GPT like ChatGPT can auto-generate financial commentary, summarizing reports, create Excel formulas, and Python code, draft valuation models for or investment memo. Use cases like AI assistance in Excel, natural language queries for financial analysis, generating scenario-based narrative. Then next slide is Automation in financial workflows. The task can be automated is monthly reporting, dashboard update, capital budget tracking, various analysis, and this tool useful for Excel macros, VBA, Python scripting, RPA, and Power Automate. In this automating Excel task using Python and AI, use API or bots. And this is helpful for saving our time, reducing errors, and boost productivity. Then predictive analysis using AI. AI in that what will happen forecasting, why did it happen, who truths. For example, uh, forecasting revenue and expenses market trends, then useful for historical data and ML models for prediction, and tools are used from Meta, XGBoost, and Arima models. Then AI for the risk assessment. The AI identifies and qualifies risk better than traditional models. In that, three types of risk is credit risk, market risk, and operational risk. In credit risk, predict default likelihood, and market risk analyze price velocity, and operational risk is detect anomalies and processing data. AI based risk models update dynamically as a new data comes in. Then NLP in finance, natural language processing, useful for reading earnings and call transcripts, and extracting sentiment for news articles, summarizing analysis, analyst reports, compliance, and regulating scanning. It helps to analyze, process vast unstructured data in real time. And the robotic process automation in finance. RPA tools like UiPath and automation and anywhere automate rule based on tasks, that is invoice processing, data entry and extraction, report generation, integrated with AI for smart automation, bots that read emails and take action, bots that interact with financial software, and then chatbots and virtual financial assistants. GPT powered bots now the help clients access statement, provide investment advice, and answer FAQ in banks and fintech platforms. The benefits is 24 by 7 service they are provided, and cost reduction and human like interaction. This is used in banks, wealth tech apps, and accounting platforms. Then Excel, Python, and AI integration. Using Python models for prediction, use Excel for presentation and dashboards, and to connect them via Wix and OpenPY Excel. For example, Python forecast revenue using ML, Excel dashboard displays live outputs, and GPT writes commentary based on their results. The outcome of this Excel plus Python plus AI integration is intelligent, real-time, and automated models for the finance teams. Then use cases in AI stock valuation. AI is used to improve accuracy in equity valuation. In data source, historical prices, earning reports, and sentiment from news and NLP. Models use models uses XBoost, LSTM, and linear regression. The output of AI stock in valuation is predict value fair and enhanced decision making for trader and investment. And AI helps to uncover insights traditional valuation may miss. Then AI in credit risk modeling. It means AI models assess borrowers apply to repay. Then input variables, income, spending, credit history, or an app usage. The techniques of AI credit risk modeling is classification algorithm, means logistic regression and decision trees. The outcome of this AI in credit risk modeling is more inclusive credit access, better loan approval decision, and lower default risk. For example, used by digital lenders and fintech platforms. Then real-time financial dashboards with AI. The financial dashboards powered by AI can predict future performance, monitor real-time KPIs, alert on anomalies, and tech stack in Python backend, Power BI and Table U frontend, Excel integration for manual inputs. Use case CFO dashboard for real-time strategic decisions. Then anomaly detection in financial data, identifying frauds and unusual patterns. The detection in financial data used to anomaly detection in financial data. It is used to detect fraud and operational errors. Algorithm use isolation forest. Then then uh,
Zoom in your slides.
yes. Future of AI financial modeling. In that, Gen AI's role in automation modeling. Then AI agents to for end-to-end financial planning, and they merging AI to blockchain, web, and AI. Then the conclusions and takeaways of AI modeling in AI is a transforming financial modeling across all dimensions. Learning Python and AI tools is essential for modern financial professional and emphasize the ethical use and explainability and integration in Excel. Then introduction of AI. Then introduction of AI. Introduction AI in use cases in finance. Brief overview of AI adoption in financial modeling. Purpose of section is to showcase the practical example and industry impact. Then types of example is startups, large corporations, before after AI transformation. Then startups and lending AI in financial modeling. Um, many many fintech startups are using AI first, and then examples. For example, is Just Money, Upstart, and ClearTax in India. They are focused on their speed, automation, and credit risk in modeling. Then Just Money, AI in credit risk scoring. The problem is millions in India and lack of formal credit scores. And the solution is Just Money uses ML on alternative data and the impact of the more inclusive financial access. Then Upstart and AI-driven lending all evaluated 1,600 plus variable for the loan approval, and it reduces default rates while approving more loans than traditional methods. The Upstart is using AI, using before AI rigid credit score rules, and then after AI they are used personalized risk-based lending. The clear tax, tax automation with AI. ClearTax uses AI for document reading, GST filing, and cash flow forecasting. Then they using before manual from entry after OCRM plus ML and auto field returns. Result is 80% time saving for SMEs. Then large corporations adopting AI in finance. Corporations use AI for modeling, forecasting, and compliance. For example, JP Morgan, Chase, BlackRock, and PwC, and they focus on scale, accuracy, and process efficiency. Then JP Morgan case, coin project. In that, contract intelligence coin. Then AI scans legal documents before 3,60,000 hours slash years for manual review and after seconds with NLP and reduce legal risk and cost. Then BlackRock AI in portfolio management. In that uses AI and ML to optimize portfolios, and then AI driven insights in on risk market sentiment and asset correlation. Then before AI human portfolio manage after augmented intelligence. Then PwC AI for the financial audits. They uses machine learning and NLP to analyze general entries to detect anomalies. Then before AIs, they are used sample-based manual audits, and after AI, they used full population full मतलब full full population review, increase fraud detection in accuracy. Then AI in forecasting revenue. The scenario of AI is forecasting the news company uses past 5 years sales data Then AI model XGBoost and LSTM forecast next quarter's revenue. Then result is 30% better accuracy than linear regression. Before and after AI manual budgeting versus ML based planning. In that before AI manual budgeting versus ML-based plan is static Excel spreadsheets and manual assumption, and after dynamic models using real-time data and AI-based drivers. Then tools use is adaptive insights and NA-plan Python. Use case AI in inventory and working capital. AI predicts then inventory levels, predicts demand spikes or drops, payment cycles in flags of delay or early payment patterns in working capital efficiency, improves days sales outstanding and days payable outstanding. The impact of these case use reduce carrying cost and unlocks tied up capital. Then AI for fraud detection in payments. AI models detect unusual transaction patterns like large transfers, rapid withdrawals, and country IP mismatch. The methods of this AI fraud detection of payments is anomaly detection, behavioral profiling, and real-time alerts. That is used by this is used by in banks, NBFCs, payment gateways. Then AI for ESG analysis. For example, company example is RBCQ. This is a German company uses AI to score companies to ECG metrics. And AI scans over 1 lakh plus news articles per day and send to compliance. It helps to build sustainable portfolios and detects greenwashing and compliancing issues. Then AI power expense management. Then AI scans receive emails, credit card data, and categories and flags of expense automatically and suggests budgets and alerts user. They are tools using the XP5 Zoho, Trezor PX, and AI. It helps to expense workflows. Workflows are smarter, faster, smarter, and requires minimum manual input. Then case study is AI financial advisory. Uh, the hedge fund are incorporate AI models in competitions. Data scientists submit models without seeing the actual data, and blockchain ensure privacy, integrity, and transparency. Other applications, smart contracts, and real-time audit trails. Then automation of the financial reporting. The company of in company SAP uses AI to auto generate quarterly reports. Then before teams needed weeks, and after AI doesn't is it in minutes. Enhance compliance and real-time height. Then AI in IPO and valuation. The case use AI to simulate IPO outcomes and AI assess market condition, investor behavior, and timing. Result is high IPO pricing. Then emerging trends, AI plus blockchain finance, combining AI-driven analytics with blockchain and transparency. Using smart contracts, real-time audit trails, and startup example is Numera uses encrypting AI competitions. Then key takeaways from case studies is AI startups like Zest Money, ClearTax use AI to scale faster and reach unserved markets. And in corporation, JP Morgan, BlackRock, and PwC invest heavily in automation and predictive analysis. AI helps with speed, accuracy, personalization, and better financial conclusion. And It is helpful for AI isn't buzzword. It is a competitive advantage of modern finance. And then recap of key learnings. In that topic covered in Excel based financial modeling, like formulas, pivot tables, and dashboards. Second one is the advanced Excel and VBA. Third one, scenario and sensitivity analysis. Fourth one is the DCF modeling, and fifth one is the AI in finance. The conclusion of this e-learning is combining human intuition with machine intelligence leads to smarter business and decisions. Then the growing role of AI in finance. Uh, in that overall 80% financial institutions are investing in or experimenting with AI. And then the key applications of this AI in finance is credit scoring, risk analysis, investment modeling, automated reporting, real-time fraud detection. Then next is from Excel only to AI augmented modeling. In a traditional skill set, Excel proficiency, and one future skill set is Excel plus Python plus AI tool is integration. Then in then also traditional skill set is manual reports. In a future skill set is automated AI driven dashboards. Then traditional skill set in static forecasting. In future skill set in real time predictive modeling. The takeaway of this AI to augmented modeling is finance professional must involve from data entry to data interpretation and decision making. Then next one is the impact of impact on finance job. Then AI won't eliminate finance job; it will change them. Then repetitive work convert to automated, and analytic work is convert to augmented, and new roles converted to AI auditors, finance automation analysis, and data-driven CPOs. They are upskilled professional with lead transportation is not fear it. Then next is involve skill set for finance professional one. To stay competitive, finance pro must there are must technical skills are required. That is Excel, advanced Excel, Python and Power BI and SQL for data querying. And they are also useful AI tools like Skillset Intern, GPT based tools, and soft skills are required is analytical thinking, data storytelling, and adaptability. Then AI doesn't replace its arguments. AI support faster and with better accuracy. Human judgment is still crucial, especially in interpreting AI outputs. Collaboration between humans and machines and optimal results. Future trends in financial modeling. The key trends to watch AI-driven forecasting, that is real-time self-learning models. In second one, natural language queries. In that, ask Excel, show me the next quarter of revenue. AI arguments. Third, in that, automate entire financial planning process. And then Web3 blockchain. In that, smart contracts plus real-time audit. In that, financial modeling is involving into automotive decision making. Then next is learning roadmap for student and professionals. First one is the basics of financiers, finance and accounting. Second one, masters of master Excel in financial modeling. Third, learn Python or understanding machine learning, build use cases, learn tools and few dashboards, and then And then learn tools, and next is the build dashboards and AI integrated models. Capstone project. Then next is the final thoughts. The key messages of this financial modeling is no longer needed about just a spreadsheet. It is a strategic decision making tool supercharged by AI. Then learn continuously, experiment with tools and stay curious. And then start small and scale smart.